As of today, Sunday, December 21st, 2025, the market is currently closed, but looking back at the most recent trading session, UiPath, trading under the ticker PATH on the New York Stock Exchange, finished at 16.12 USD, marking a steady climb of 0.18 or about 1.13% for the day. While that single-day move might seem modest compared to the high-octane volatility we often see with names like NVIDIA stock or even the daily swings of Tesla stock, there is a much deeper story playing out beneath the surface of this 16.12 price point. The immediate insight that most people are missing is that UiPath has quietly moved from being a simple automation tool into a legitimate backbone for enterprise intelligence, and the market is finally starting to price in a shift that wasn't even on the radar 6 months ago. Most investors looked at the massive drawdown this company took over the last couple of years and assumed the story was over, but the reality is that the underlying financials have just hit a massive inflection point that contrasts sharply with the legacy label the street tried to pin on them. When you look at the recent stock movement, the numbers tell a story of a localized recovery that is outperforming many of its software peers. In the last 3 months alone, we've seen the price surge by more than 50%. This wasn't just a random rally driven by general market optimism or a rising tide lifting all boats in the tech sector. It was a targeted reaction to the company's third-quarter fiscal results, which fundamentally changed the narrative. For a long time, the expectation was that UiPath would struggle to remain relevant as larger players like Microsoft or Salesforce integrated basic automation into their own ecosystems. The reality, however, is that UiPath just posted its first GAAP-profitable third quarter in company history. They reported a net income of nearly $199 million, which translates to a diluted earnings per share of 37 cents. If you compare that to the consensus estimate of 15 cents, you start to see why the institutional players are suddenly scrambling to recalibrate their models. This earnings beat was backed by a revenue increase of 16% year over year, reaching $411 million. But more importantly, their annual recurring revenue, or ARR, hit $1.78 billion. In the world of online investing and self-investing, ARR is the metric that matters most because it represents the predictable, sticky income that keeps a software firm alive during lean times. While many people are busy looking for the next big thing on various investing sites or looking for investment help through a robo-advisor like Schwab Intelligent Portfolios, the smart money has been quietly watching Path's ability to maintain a dollar-based net retention rate of 107%. This means that even without adding a single new customer, their existing base is spending 7% more than they did last year. That is a sign of a product that is deeply embedded in the workflow, not something that gets cut when a CFO looks to trim the fat. If you are using a Fidelity trading platform or perhaps the Robinhood app to manage your individual brokerage, you've likely noticed that the volume on Path has been ticking up significantly. We saw over 18 million shares change hands in recent sessions, which is a notable jump from the typical daily average of around 15 million. This kind of volume usually points toward institutional rebalancing. Big names like Vanguard and BlackRock still hold massive positions, and while we've seen some high-profile exits from firms like ARK Investment Management earlier in the year, the new buyers coming in seem to be more focused on the fundamental shift toward what the industry is calling agentic automation. This is where the gap between expectation and reality gets really interesting. The common belief was that simple bots were a commodity. The reality is that UiPath has moved into agents that can actually make decisions, which has allowed them to close larger contract sizes and speed up their deal cycles. The institutional activity suggests a growing confidence that the company has finally found its footing. When you look at the options market, there's been a significant amount of interest in the $17 and $19 price targets for early 2026. This indicates that professional traders are betting on a continued breakout. If you're doing your own online investment through an interactive brokers platform or using SoFi Active Investing, you have to weigh this momentum against the macroeconomic pressures that still haunt the tech sector. High interest rates have made investors much more selective, often preferring established giants like Apple stock over smaller growth names. However, the fact that UiPath is now showing actual GAAP profitability while maintaining double-digit growth is a rare bird in the current software landscape. Let's take a step back and look at what this company actually does for those who might be new to the ticker. UiPath started as a specialist in robotic process automation, essentially creating software robots that could mimic human actions on a computer, like moving files, filling out forms, or extracting data from documents. For years, the knock on them was that they were too focused on the old way of doing things. But the business model has shifted toward a unified platform that combines these robots with advanced machine learning. They now offer a comprehensive suite that handles everything from process mining to document understanding. Their gross margins are staggering, sitting at around 83% on a GAAP basis. This high margin is what provides the fuel for their research and development, which they've been pouring into their agentic framework. The recent history of the stock has been a lesson in patience. After their initial public offering, the price was caught up in the growth at all costs frenzy, leading to an eventual and painful correction. But the company didn't just sit on its hands. They focused on operational discipline. They cut costs where they needed to and doubled down on high-value customers, those spending over $100,000 a year. Today, they have over 2,200 of these large-scale clients. This transition is why you're seeing analysts from firms like RBC Capital and Morgan Stanley raise their price targets. They are seeing a company that has matured from a speculative growth play into a disciplined software powerhouse. Looking ahead to the fourth quarter and into 2026, the catalysts are fairly clear. The company has guided for revenue between $462 and $467 million for the next period, with a non-GAAP operating income expectation of around $140 million. If they hit the high end of that range, it will be the strongest signal yet that the turnaround is complete. The risks, of course, are always there. There is intense competition, and if the global economy slows down further, enterprise spending on software could be one of the first things to get hit. Furthermore, as they transition more customers to their cloud-based offerings, there is always a temporary drag on revenue recognition that can make the headline numbers look messier than they actually are. For those of you tracking your performance on a Fidelity mobile app or checking your Robinhood investments, it's worth noting that Path's current valuation sits at about 42 times trailing earnings. This is actually lower than many of its peers in the high-growth software space, yet its profitability profile is improving faster than most. The expectation is that the company will grow revenue at a steady 8 to 10%, but the reality might be an acceleration if their new AI-driven products take off the way management suggests. They already have nearly 450 customers using their agent-based workflows, and that number is growing every month. I want to hear your thoughts on this one. Comment below how many shares of Path you currently hold, or if you're waiting for a specific price drop before you enter a position. Do you think the shift to AI agents is enough to keep them ahead of big tech competitors, or is the $16 range where this stock belongs for now? It's these kind of specific discussions that help everyone in the community refine their own investment strategy. When we talk about self-investing and picking individual stocks, it's easy to get distracted by the noise. You see people talking about how everything is AI now, but with UiPath, you can actually see the results in the cash flow. They ended the recent quarter with over $1.5 billion in cash and cash equivalents and zero debt. That is a fortress of a balance sheet. It gives them the flexibility to make acquisitions or continue their share buyback program, which is another way they are returning value to the people who hold the stock. Whether you are using a SoFi trading platform or a more traditional Fidelity brokerage, that kind of financial stability is a massive comfort in an uncertain market. The contrast between the common market narrative and the actual performance is what creates the opportunity here. The narrative says UiPath is a legacy automation company being disrupted. The reality shows a profitable, cash-rich firm that is growing its recurring revenue and expanding its footprint within the world's largest enterprises. They aren't just selling a tool anymore, they are selling an operating system for work. As we head into the next year, the expectation will likely be that they maintain this steady path, but the reality could be a significant re-rating if they continue to beat on the bottom line. To wrap things up, the core insights for Path right now come down to three things: a successful pivot to profitable growth, a massive cash cushion that protects them from market downturns, and a product suite that is becoming more essential, not less, as companies try to figure out how to use AI effectively. We've seen how the expectation of failure kept the stock suppressed for a long time, but the reality of their Q3 performance has broken that spell. While the price is sitting at 16.12